Okay, welcome back, everyone. It's good to see you. So we are in the last 2 weeks of the course. Congratulations to those of you who have finished. And actually, you know what? In the past 6 years, this is the first class where the majority of people have finished in before the 6 weeks. So that says a lot about all of you. Most of you will finish this week, all right? So don't worry about it. If you're behind, please reach out to me so I can help you, okay? We'll just schedule a Zoom session. Also, for this week's homework, please don't get caught up. Don't get hung up on it. Don't overthink it. Just put whatever comes to mind on there. It's not so much about the plan as it is about the planning process, and things will change, okay? And it's fine. It's what needs to happen. All right, you have a great speaker tonight, so I'm really excited to turn it over to Deanna.
All right, well, welcome everyone. Thank you for being here. We are in week 6. We only have one more week left. It's great, but it's also sad to see everyone go because I won't be able to get to see your faces each week. It's so hard sometimes virtually because, I see you for a time and then I may never see your face again. But I hope that we'll continue to hear from you. And speaking of the end of the course, you'll be getting an email from me at the end of the week this week with a link to register for the Alumni Services Orientation. The Alumni Services Orientation, we're looking to schedule that for the week after next, I believe in the middle of the week. So it's going to be during the day, so it might not work for your schedule. But just like all of these live sessions, that will be recorded and you will be sent a link. Once you register, you'll be sent a link. Register whether you can attend or not. That way we can make sure we get a link out to you. I believe through that registration, there are ways to ask questions. If not, I will make sure there is. And what that orientation will be is really you'll meet with Elvis. I'll be on it as well just to listen in. He's going to go through a presentation about, now that you're a graduate, what are the resources that are available to you right now? And if he doesn't mention a specific resource that you need, he'll also share how to connect with him and connect to get those resources in the future. Because we have an alumni services team, and they're here to serve you, and they are the best people to go to for the connections. If for some reason you ever reach out to them and you don't hear back within a reasonable amount of time, you can always email me and I can connect or see what's going on there. So anyways, with all that being said, I did want to let you all know we're not completely sure what's completely going on, but Ken Wasselben, who was going to be one of our speakers tonight, has let me know that he is in the hospital. He had to go to the hospital yesterday and he said he was going to be there for a couple of days. He didn't let me know exactly what's going on, but he did tell me not to worry. So, right now, all of a sudden, you instantly think COVID, but we don't know that for sure. And so just be thinking about him and keeping him in your thoughts. However, in his absence, one thing that Ken is very good at is teaching. And I have uploaded 2 videos as an announcement in Blackboard just a couple of minutes ago, where Ken explains the economic business model. It's actually a business model that was created at Syracuse University by professors in the entrepreneurship department at Women's School of Management. So Ken was a part of that creation, and he talks about them. He's a phenomenal teacher. So please make sure to check out those because that's one thing he does talk about usually in this session, is what the economic business model is. So please go through that, take a look at those, and I think that that'll be very self-explanatory. But notwithstanding, we also have a second speaker who is here with us. They have done a great job, been a part of, I believe, this will be the 5th cohort they've been a part of. or all 4 cohorts, excuse me, that they've been a part of. They've taught in tandem every cohort for financing. And Eva also she works at a bank and has a lot of knowledge in a bank, but she speaks at our VWise program very regularly on access to capital, introductory classes, and maybe a little more in depth. So she is very knowledgeable on the topic as well. So I think between the 3 of us, Sandra, myself, and Eva, we can get the questions answered that you have tonight. So without further ado, I have been talking, going on and on and on. I will let Eva go ahead and give us a little bit about yourself, if you would. And then we'll kind of start off with kind of some introductory questions. And then I'm sure the group will have some as we continue the conversation.
Sure, let me get off mute there. So good evening, everyone. I'm really, really excited to be here and want to thank all of you all for your service. So I am Eva Brown, and currently I work at Fifth Third Bank in the Community Economic Development area as the Lending and Investment Strategies Director. So in short, what that means is most banks are charged with a federal regulation to make sure that we're lending and investing in low to moderate income areas and underserved communities. And my role is to make sure that I'm working with the different business lines within the bank to reach the right constituents. So I've been doing that for about 2 years. I've spent the majority of my career working with small businesses within the banking sector. So I've worked as an underwriter, I've worked as a portfolio manager, I've worked as an actual relationship manager, so charged with getting, sales going out. So I'm really, really familiar with the small business lending space. So happy to share information about that from a banking point of view. I was introduced to VWise in the program through my employment at the Women's Business Development Center out of Chicago. And there I was the director of the Access to Capital program. And so from that seat, I was able to help businesses directly and connect them with different financing sources, including our own, which is a small business loan fund, which we raised money for, and we were able to lend money to businesses that could not go to the bank traditionally. So again, I'm happy to be here, happy to answer any questions. If you have any burning questions about, from a bank and you're not quite comfortable approaching a banker, and, to be completely transparent, bankers aren't that transparent, but I can be. So I'm happy to answer any questions that you have.
Thanks so much, Eva. So I guess the first question comes from Alania's cat. And that would be no, just roll. I love your cat. Your cat's so cute. I love cats. Anyways, so if you could just, since we're kind of, you're in the banking world, and we'll talk like currently, we'll talk a little more about some of the other avenues of funding. Could you kind of just expand a little bit on, if is bank a good way to go? Is a loan a good way to go to start your business? Number one. Number two, if that's the way to go, what should you be looking for, or what are banks looking for to be able to, guarantee or provide your loan?
Great. First question. So ideally, when it comes to small businesses, banks are the best place to go. So we'll leave that statement as is. And the reason being is that banks, from a pricing perspective, banks are probably the cheapest source of capital that you can ever get. You'll never find rates lower than you will find at your local financial institution. However, while they're a great place to go, and the reason that they're priced lower than every other lender is because they take the least amount of risk. So while it's a great place for new businesses to go, the real question is, will that bank have an appetite to fund your business? Banks really typically, they look backwards when determining how to lend money, right? So they feel comfort, and they get comfort in looking at historical financial statements, because as banks, we believe that the historical activity will predict what happens in the future. And where you run into a challenge as a startup is you don't necessarily have that background to look at. And so it doesn't really give a bank or a lender a basis as to which to make an analysis if you would be a good borrower or not. So if you can go to a bank, yes. I will say for younger businesses, you have a much better opportunity of getting something smaller like a credit card through a bank, just given the underwriting guidelines. But when it comes to real, just kind of firm startup capital, you're going to really run into challenges. And I'll kind of answer your second question is, what is the bank looking for? So banks, and I'm sure you all have heard this, but I'll speak from a financial institution point of view. The 5 C's of credit, those are totally real, and those are totally evaluated as it relates to getting, credit at a bank. So I'll go through each of them and just kind of talk high level about what a bank may be looking for. So first and foremost, I'm going to start with credit or character, which is not typically the first C. Most people say cash is king. But when you're thinking about a startup business or a young business going to the bank, it's really important to understand how important credit score really is. It's a determinant of your character. But when you were scoring or looking at applications, that's one of the first things that banks go to. They look to see, from a personal perspective, how have you managed your finances, because they believe that that's indicative of what you will do with your business. And I know we'll talk about alternative forms of financing later, because I hate sounding so negative, but it is that, if you don't have a credit score, that's probably going to be a good credit score. That's probably going to be one of the biggest hurdles to overcome when you're looking at a regular bank. There's really not a whole lot that banks move as it relates to score. They're really score driven because it's more efficient, right? So a lot of larger banks, they're putting applications through algorithms and computers, and that computer is really going to say, hey, is this credit score above or below 680 or 660 or 700, depending on the institution. And if you're not there, then it's typically going to spit a decline without even doing an analysis on the remaining C's. So the second C, we'll talk about cash flow. So cash flow from a bank's perspective, as I mentioned earlier, it's looking backwards. So they're typically looking at tax returns for the last 2 to 3 years, and they're really looking at that net income or net loss number with some different add backs, for non-material things or non-cash things. And that's how they really determine, do you have the ability to repay? And so I think what's really important to know there, notice I said tax returns, right? And so business owners and people in general, they love to be tax efficient, right? So you want to report the lowest income possible, which lowers your tax obligations. But know that when you're trying to borrow money, the lower taxable income you have, you're illustrating the lower the amount of cash that you would have available to repay debt. So you've got to kind of have that really good, robust conversation with yourself, your accountant, your financial advisor to say, I want to take as much deductions as possible or, whatever, but the lower your taxable income, the lower amount that you're going to be able to borrow. The next C that I'll quickly talk about is collateral. So banks, again, we're notoriously very, very conservative in our lending. And the first form of repayment we typically like to see is cash flow, which I just talked about. But, banks are, if you don't have the cash flow to repay the debt, the bank doesn't just go away quietly. We need a second source of repayment. And that second source of repayment is called collateral. So typically, in most cases, loans need to be backed by an asset that can be liquidated in the event of a default. So common assets that are really used for small business lending are homes, personal homes. And I say that first because most newer business owners, they don't have any other assets within their business. So they've got to put up their personal home for collateral. But things like, machine, equipment, account receivables, inventory, they're looking at that to make sure that you've got some collateral to back the loan. And usually they're looking for every dollar that you borrow, they want $1 in assets that can be liquidated, right? So it's a dollar for dollar match. Sometimes if you do have a shortfall, that's when the SBA can kind of come in and shore up the rest of it. But when I say shortfall, let's say if you're borrowing $100,000 and you only have, let's say, $80,000 in collateral, that's a shortfall. But if you've only got $10,000, that SBA guarantee can't make up for that 90% difference, if that makes sense. But I will acknowledge, though, as you move past what they call the startup phase, which is kind of that 2 years in business or 3 years, depending on the financial institution, at that point, you may be able to apply for unsecured credit, which does not require any collateral. But again, that's only offered to like the creme de la creme borrowers that have really strong credit scores and cash flow. So moving to the fourth C, which is conditions. or I'll say capital, I'll go with that one, which is, again, it's more about the equity and it's looking at what have you invested in your business. So, the theme is before you, go outside looking for someone to fund your dream, what have you put up yourself? And again, so it's usually a percentage. So we're looking at what is the total amount or project cost or whatever you're looking for. And they're going to usually expect for you to, at the low end, bring in 20% of whatever that is. And that equity is not sweat equity, right? So a lot of small business owners think, well, I work in my business and I'm not paying myself, so that's my equity. Nope. They want to see real equity. So that's hardcore cash that you put into the business is really important. And again, with SBA, there are some programs that allow a lower downstroke, so maybe 10%, just depending on the program. And so the fifth C is conditions. And so that's, again, more about kind of what is happening in the external environment that can impact your business. So that's competition, like how do you differentiate your product or service, or how do you really illustrate that there is a need for that product or service, right? And what else is happening? I think COVID is a really great example of conditions being an impact on a credit decision. So you think about all of these COVID restrictions, and if you're opening, we'll pick on the easy target restaurants, right? And if you're in a state like Illinois, like me, where they've got some really strong restrictions there, as a credit officer, they're going to be looking at that to determine how does that impact your ability to earn money and repay the loan. So that's what a bank looks for. The box is pretty small. I'll be very, very transparent, especially for younger businesses. So we always like to, be really upfront about that. So that was a really long answer, so sorry.
No, that's good. I mean, that's what we want, right? Getting those, can you just say those five C's again, just the C's?
Yep. So character, cash, capital, I got confused, collateral, and then lastly, conditions.
Got it. Thank you. So let's kind of stay on the topic of kind of things, loans for now, if we can. I know you mentioned you kind of hinted towards CDFIs, but could you talk a little bit about what is a CDFI? I don't know if anybody in this class has ever heard of a CDFI. It is kind of a newer thing in the last couple of years. So if you could kind of explain a little about that, what are the advantages of that over kind of a traditional loan?
Sure. So I'll start off with just kind of what they are. So CDFIs, Community Development Financial Institutions, it's a certification that can be assigned to a lender, and that lender can be a nonprofit, it could actually be a bank, it could be a credit union, but essentially the certification, which comes from the U.S. Treasury, is affirming that this institution has a mission of serving an underserved population. So for example, I serve, it's a long name, but I'll give it, but it's called the Chicago Neighborhood Initiatives Microfinance Group. So I chair the board of that nonprofit organization, and we're a CDFI, and in our mission, we contend that we lend 60% or more of our dollars to businesses that are low to moderate income. So that's why we get the certification. And the certification is important, one, so that borrowers know kind of who these organizations are, but it also dictates the type of capital that we attract, right? So as a bank, a part of my job as Lending and Investment Strategies Director is I take capital from the bank's balance sheet and I put it in CDFIs, right? Because we know that there's oftentimes from a traditional lending, a bank perspective, that we see a lot of borrowers where there may be startups or perhaps there's some imperfections within their credit profile that prevents us from making the loan. We can refer them to a CDFI and we're putting our capital on their balance sheets. So CDFIs really step in where the banks can't, right? So everything that I just went over as it relates to the 5 C's of credit, CDFIs look at the exact same things. However, their box is so much larger than what a bank is. What we like to see or say is CDFIs, they really do a great job of understanding the story behind the credit and making credit decisions based on that. So Deanna, I'm going to go through the 5 C's of credit from the lens of a CDFI so you can really understand the difference. So
great.
we start with, again, we'll start with character or credit and talk about that. So as I mentioned, banks have hardcore scores and overlays, and there's just not a lot of flexibility. So most CDFIs, they don't have credit score minimums, and if they do, it's probably going to be at that 600 or 580 or 560 mark. And that's not to say that they don't care about your credit, but they really want to understand what's in your credit and why. So was it a loss of job? Was it an illness? Did it have to do with your military deployment? They want to know what that story is, and then what is the plan to remedy the credit. And that's more important than the actual number itself. Then moving on to cash flow. So as I mentioned with the bank, they like to look backwards, less risk. But CDFIs, actually, they look forward, right? They may look at your bank account balances to kind of get an idea of what's happened and kind of what comes in every month. But by and large, they're looking at what's the business opportunity in front of you, and making a decision based on that. And that's something that banks, just from a regulatory point of view, can't do. Same thing with collateral. Again, CDFIs, often they will make an unsecured credit, make an unsecured loan to borrowers, but they will like to look at what type of assets do you have and what can you offer up. So for example, I say this to say, if you have an asset, a CDFI wants it, right? But they're not going to deny you the loan just because you don't have it. So I gave you that kind of that 90, if you wanted a $100,000 loan and you only had, let's say, 10,000, 20,000, are you putting up what you have? They're not going to punish you for not having the available assets to back the loan. They're much more flexible in that extent. Then moving on to kind of capacity, or kind of the equity piece, same thing. Are you putting up what you actually have? So if it's not at that 20% level that's stated, but you've given us, whatever you can to that extent, that's usually okay for a CDFI. And then lastly, they're looking at the conditions as well. But again, and I think one of the biggest differences between a CDFI and a bank, especially when we're talking about smaller loans, and when I say a smaller loan, we'll call it $250,000 and below. Usually those loans, from a bank's perspective, there's one human that takes a glance at it, but there's not a real deep underwriting. Usually most loans, even our very small loans for CDFIs, they go through credit committee. And that gives that lender, whoever that officer is at that CDFI, an opportunity to talk to 5 people to tell them why they should take a risk. And it may not look great on paper, but that lender can really articulate your story and talk about the impact that you will have in your community and the business community. And that's how they're making their credit decisions. And they do really well at it.
Thank you. I appreciate that. I'm going to continue to go through my questions as a class. Sometimes you don't even know what to ask in certain cases. So we'll continue going through my questions, but just as a reminder, if you have a question that you want to ask, all right, Mark does. You can either raise your hand like that, you can raise your hand via the button, or you can put it in the chat. Mark, why don't you go ahead? Because we'll stop and I'll just continue I'll make sure we hit everything that we need to hit. So go ahead, Mark.
Okay, thanks. Eve, the question I got on a CDFI, you work with the bank works with the organizations, right? But how does the bank benefit from it?
Oh, that's a really good question. Yeah, really good question. So a couple of ways. So the primary way is we get what we call credit under the Community Reinvestment Act investment test. So that's a federal regulation that all banks have to adhere to make sure that we're making investments to lower to moderate income people, or that can benefit low to moderate income people. So every time that I do make that investment in that CDFI, I get credit and I get to tell the regulators the story that, hey, we're doing our best. We're trying to lend inside of the bank. However, when we can't lend, we've made an investment into these organizations. Secondly, which is my favorite part of it, is really knowing that CDFIs, they're not full service banks. So they don't take deposits. They don't have cash management products. They don't have all these ancillary services that a bank has. So for us, we would much rather tell our customers, we're not ready to take that credit risk, we can handle the rest of your business. We can refer you to a partner lender like a CDFI, and then work with you in the interim to kind of get you those steps, those things that you need to do so that you can come back to us. Because the goal is not to have business owners stay at CDFIs. Those should be short-term loans while you build your balance sheet and what needs to happen so that you can come back and get traditional financing. Because, you know, the long and short of it is, like I mentioned in the first question, banks are the cheapest source of capital you can get. Now, CDFIs aren't, you know, super crazy expensive, but they're more expensive than banks. So our goal is to cycle you back out of the CDFI and back to the bank.
Oh, thank you. Now I understand. Appreciate it.
Thank you.
Great. So Eva, is a loan, in your opinion, is a loan the first thing? So if we're just a new business owner starting out, trying to get some capital, would a loan be the best first option, in your opinion?
Yes. If you so that's an interesting question. So I'll answer it two ways. Yes, if you need to raise outside capital, right? But the one thing that you've always got to remember about borrowing money is that it has to be repaid, and it has to be repaid relatively quickly, right? So if you're a startup business and you're just getting started, right? So you're going to need the money to, you know, get your operations up and running, and you're spending money before you even have a customer come into the door, right? And so ideally, those customers coming into the door, that revenue that you're booking is what you're going to use to repay the loan. But what if you have a snag, right? So I always tell folks, like, as you're getting started, you know, you want to try to go into it with as least obligations as possible, because it's going to be a rocky, you know, 6 years to a month to almost 2 years. And if you got this big loan payment that you have to pay every month, that can be extremely stressful. So the other type of capital, obviously, is equity, right, which is much more patient, if you will, as it relates to financing a business. When people put in equity, whether it be their own money or someone else's, typically that equity is more patient and can sit there until the business is profitable and can be, you know, and then it can be repaid. But with loans, you've got to start paying right away, and that can put you in a bad spot. So it's not that it's not a good idea, because sometimes that's the only idea, but you've just got to be mindful that that's a really stressful obligation. That's typically, for example, if we're doing a loan, we may give you a 6-month or 3-month interest only period, but you still have to pay something. And then once those payments start, you've got to pay. So, you know, as a startup business, that's something to really be mindful of.
Thanks, Eva. So, you know, being that a loan may not be the best option for some people, what are some other options for funding business and getting, you know, I mean, I could start listing a bunch, but let's see what you come up with, and then we'll kind of maybe dive into a couple of those.
Yeah. So, I mean, first and foremost, it's available. It's all, you know, friends, families, and fools, and your own money, right? So that's first and foremost, right? You know, whomever you can grab it from, but in a formal way. And I'm so sorry, because I have a dog and he is just moving. Okay, I have to move that. Sorry, I'm trying to keep him at bay here. So I would say first, your equity providers, friends, family, and other people, right? Making sure like you can get money from them and you can get it documented. There's also other forms of capital, like if Ken was here, he would talk about his former business, and he does what they call invoice financing, right? So it's not necessarily debt, but it's a company that takes your invoices. Let's say you've got a client and it's a corporate client, so you're selling to another business, and, you know, they will take, let's say you've got a contract with the local government, and that local government takes 30 to 60 days to pay you. Their factoring companies is what they're called. They literally will buy that invoice from you, give you the money, and then they will collect it from your customers for a nice little fee. So that's another option there. There's always bootstrapping. So that is a very common way that, you know, sometimes you've got to do what you've got to do. And so instead of, and I'll tell a really quick story that I think is a really good example. So when I was working at Women's Business Development Center, I worked with a young lady who really wanted to open a spa. And, you know, it was an Aveda spa, which is, you know, very particular about what has to be in it, whether it comes to equipment and all this other good stuff. And when she got finished with her starter budget, it was upwards of like almost $300,000. And, you know, to go to a bank as a new startup spa, kind of tricky. So we worked through some different things. So one of the things we figured out is for equipment, most equipment companies, they have their own leasing arm. So you can lease versus own, right? And you can lease directly from that manufacturer. And typically their underwriting is a little bit different than a bank. Also, she thought about financing, seller financing. So the building, like that she wanted to go into, she was able to finance the build out because the owner paid for it, and she was able to pay for those kind of the build out, whatever structure, through her monthly rent payment. So instead of borrowing the $100,000 plus that it would have required to actually retrofit the building and get it ready, she was able to finance that through the seller. So there's a couple of different ways. You've got to be really creative.
Thank you. I appreciate that. So there are some of these some in this class, whether they're watching the recording or currently here, a few are trying to make a determination on if it's better for them to be a nonprofit or for-profit, and thinking about that. You know, there's other questions about business model and business structure, but really when it comes to funding, are there different ways? Trying to think of how to word this. Is there a different way we acquire funds for a for-profit versus a nonprofit?
Yeah, really good question. So, you know, the primary difference between the two is, you know, for-profit businesses, you're getting your revenue from projected sales, you know, based on your information. Nonprofits are typically funded by grants, and those grants typically have to be asked for every year. And it's really hard to forecast it. So the two big things I'll say about the difference between nonprofits and for-profits is, number one, banks will lend to nonprofits, but they typically only lend to the large, well-established nonprofits that have a really long track record of receiving funds. Another big barrier for banks to lend to nonprofits is that when you borrow money as a small business owner from a bank or CDFI or whomever, you're borrowing money as the business, but as the person, the owner of your business, you're guaranteeing that loan, right? So, you know, ABC Company gets the loan, but the guarantee is Eva Brown. And that means essentially if ABC Company cannot repay this debt, then Eva Brown as the guarantor is now responsible for repaying that. When you have a nonprofit, guess what? There's no owner. So when something goes wrong, there's not a person necessarily that a lender can actually go to say, give me the money back, which makes it really hard to lend to, which is why banks typically go with the larger, more established nonprofits with endowments and so forth and so on. So the biggest difference is you have to think about the funding model differences between nonprofits and for-profits. And you're asking for money from funders in nonprofit, and that's really hard to predict, so it's hard to lend against.
Thank you. I say thank you a lot after every question. Just I appreciate it. So I'm going to just kind of flip switches just a little bit here to make sure that we cover the things that I want to cover. And I know that, you know, not many people do this, and you might not, but there's a couple of people I know, like Lakita, she was in a pitch competition, right? And those come up from time to time. So from your experience, you know, what are some things that, you know, investors, whether it be, you know, I know we talked about the bank, but what are they similar? What investors would look at as opposed to what a bank would look at? as far as, if they, because these come up all the time, especially in our network. We have a wide network. People connect with us when they have a pitch competition going on, and we let our graduates know about it. So there is a potential, even for small portions of money, that some of these here in the class might actually have the opportunity to be able to pitch their business someday.
So I'll start in saying this. The biggest thing when it comes to pitching or talking to an investor is, just like a bank, how will we get our money back plus more? That is it. One of the things that I think I've seen, and I judge a lot of pitch competitions, is I definitely appreciate the energy behind whatever it is you're offering, your product and service, all that energetic and why it's so awesome. But if you're not able to articulate that from a financial perspective, that's not going to bode well with your investor. So you've got to be just as passionate about the numbers as you are the business that you have. So what an investor typically looks for, here's the big difference. Investors, they give you the money and they want the money back, and they want a nice return, a really good return. And they understand that, hey, it may take a year, it may take 2 years, it may take 3 years, but when I get it back, I'm going to get it back with a lot of money. And the reason they charge so much, or what they require so much, is because they're taking much more risk than the bank would ever take. But at the same time, if you don't do well in your business and you have an investor, that investor understands that they're going to lose their money, right? So you've got to really talk about it from a financial point of view. And it's about, what are your sales projections? How much does it cost to deliver this product or service? What's your break even? What's your multiple? These are all the things, and like you see Shark Tank and, but I wouldn't say it's not, investors aren't like them, like from a character perspective, but a lot of the questions that they're asking are questions that real, in practice investors ask of businesses every day. And I think the biggest mistake is people get really excited in their business because that's their baby, they love it. But when it comes to talking about the financial aspects of it, they really kind of fall apart. And like I always say, your financials of your business is really just a manifestation of your business plan and numbers. And you should be able to tell that very articulately.
Thank you. Mark, you had put a question in as I was asking this last question. Was your question about partners in business pertaining to what Eva was previously talking about?
Yeah, we have to go back to 2 questions prior about applying for a loan. My question is, Eva, is how complicated does it get when you have partners that are trying to start a business and they approach the bank for a loan? Go ahead.
Yeah, so that's a really good question. So typically, and I'm so glad you brought that up. So 20% is what you should think about when it comes to partners. So usually when there's more than 20% ownership interest, those people are required to give their financial information and required to be guarantors. So any person with 20% interest or more, they're going to get their credit pool, they're going to have to submit a personal financial statement, and then they're going to be signing on behalf of the loan just like you would. Anyone that has less than 20%, they typically don't ask for that. So, but what you should be mindful of is, I'll say it this way, good credit doesn't make up for bad credit. So sometimes I get the question when I'm kind of doing these workshops that is, wait, what if I'm really strong, but my partner, we're 50-50 and he's not as strong or she's not as strong? And unfortunately, a weaker partner can, unfortunately, make the bank say, or the lender say, no, so that is a thing. So you've got to be mindful of that when you have partners in business, that you understand their financial situation as well, because that can impact your ability to borrow.
Thank you. Greg asked me directly a question, and I know you touched on it a little bit, but that kind of helps. Maybe if we could expand upon it a little bit, like what role does the SBA play in, because I think people hear SBA loans and they don't really actually give the loan out, but what do they do specifically? What is their role?
Yeah, so SBA has multifaceted relationships with banks and CDFIs. So I'll try to keep it as high level as possible, but and we're not going to talk about PPP because they function completely different in that space. But in the traditional way, you're absolutely right. SBA does not lend money directly to businesses. Rather, they guarantee loans to SBA lenders like banks. So basically, when banks make SBA loans, they underwrite to SBA standards. And as long as they're kind of underwriting to their standards and adhering to the SBA guidelines, what you can do is, one, the SBA loans give better terms. So typically, if you're getting an SBA loan, it will be cheaper. And when I say cheaper, the rate could be a little bit less, or the origination fee can be a little bit less, or the closing cost can be less. Usually they have better terms, and by terms, it's the length of the loan. So usually let's say if you're trying to get an equipment loan at Fifth Third, the maximum, what do we call it, amortization for an equipment loan is 60 months, 5 years. Maybe the SBA can go as long as 7 years or 10 years, which in turn makes you have a lower monthly payment. So they can do things like that. And same thing as I mentioned with collateral. SBA, because of the guarantee, instead of saying you've got to have a dollar for dollar coverage, the SBA can say maybe as long as they got 80%, we can get it there. So the SBA usually gives a guarantee, but that guarantee only comes into play after a default, right? So if you're paying your loan as agreed, the fact that you have an SBA loan, you wouldn't be able to tell it from another loan. The only time it really comes up is, again, once, let's say you default and you're unable to pay, the bank has done everything they could to try to collect, then what they do is they take that guarantee to the SBA and say, hey, pay us our 80% on the rest of this loan balance. But that's how they work with banks. But SBA does fund directly, like CDFIs, for example. Just like me as a bank, I put money into CDFI, so does the SBA. So they've got a long, multifaceted relationship with lenders.
Thank you very much. I just want to share something that Lakita had put in the chat. What she's really struggling with is when you were talking about like the return for her business is what she's stuck on. It's hard to measure what a family caregiver would be able to afford. And I agree. I think that's a hard pinpoint. It's a hard thing to do. But I would suggest look at the market and see what other people are paying in other, in your area for that type of caregiving service, and then figure out how you can sustain, figure out if you can be competitive in that space, figure out if what your price point is in that range. And sometimes it's trial and error too. If you're not getting business, you might have to drop prices, things like that. Also, Lakita, just I know, because as you're listening, when we do our alumni services orientation, we're going to have some resources that you can connect with to help you with that type of stuff. And some connections there. So just remember to, if you can't ask the question and can't be on the live session, submit it through the link that you'll get in resources that you need and information that you need there. So kind of flipping back, coming back to you, Eva, I know we've shared a ton.
Can I add something to that?
Yeah, absolutely.
And so I hear that the type of business, and I think one of the things I didn't mention is, when you're approaching a loan or any kind of lender or bank or lender, is what are you borrowing the money for? So always be mindful of that. So when you're doing your startup budget, make sure that it's aligned with the business that you want, because often folks say, hey, I want a loan for $50,000, right? And it's like, well, what are you going to spend the money on? Why do you want $50,000? You've got to really make sure that you're substantiating what it is you're borrowing for. And so a lot with these service businesses, if it's just people, are you borrowing for salaries? What do you actually need the money for? So make sure that you've got a good handle on that.
Thank you for that. Can we talk a little bit about Lakita, she said she doesn't want to scare us. She just got the vaccine and she's feeling a little ill. No problem. We hope you feel better, Lakita. But just wanted to make sure that we did acknowledge what you were saying in the chat as well. Oh, Sandra, thank you for sharing that link. So Eva, can you talk a little bit about like peer-to-peer lending and maybe some crowdfunding and things like that? Like what are those things and what advantages can they have if you're just starting out?
Yeah, so that is a newer, it got really popular a few years ago. I don't know if it's as popular, like we've heard of like Kickstart and some of these other, they're usually kind of fintech organizations. And so essentially it's much different than your traditional lending channel. But what it does is there's usually a platform in which you put up your story. It's like a GoFundMe for business, right? You tell the audience, this is why you should fund my business. And the successful campaigns that I've been a part of and that I've seen, they're usually because they go beyond, because this can make a lot of money, but they're really talking about the value that they bring to, whatever it is. So one pitch that I worked with on a GoFundMe, and it wasn't a GoFundMe, but it was a Kickstarter campaign, and she was successful in raising $25,000, is she was making care units for kids that had cancer. So they were very specific for that purpose. And it talked about how, there's really a gap in the market. You've got wigs and things for a lot of older people, but, when you think about kids and you think about them interacting in school and wanting them to feel comfortable, she came up with a very unique kind of unit for these kids that lost their hair due to chemotherapy. And she did really well. And so those campaigns, again, there's usually something that pulls at the heartstrings of people. And usually they're not repaid by money. That's another big difference between kind of peer-to-peer lending versus like a CDFI or a regular loan is usually if you invest in like a campaign like that early, your return may be a free product or an acknowledgement or something like that. They're not saying, hey, for your $1,000, we're going to give you, 20% of earnings back. That's usually not it. There's usually something that you get in return, like in tandem, that's usually like a material item.
Thank you very much. And I'd just like to say on that you're going to find out about a few companies that do this type of crowdfunding or peer-to-peer lending and all of that. You're going to find out about some specific companies once you're a graduate, because if you decide you want to pursue that company, you will get a loan. It will just depend on, some of it might depend on your credit score or as far as your interest rate on that loan, but you would be guaranteed a loan, small amounts. There's also a couple that you'll find out where, like for instance, Kiva, if you've never heard of them before, basically you put in a certain amount of money to show that you can do this. And then in turn, they will match it. And then you will have zero interest for 6 to 36 months. And there's more that goes along with Kiva as well. But you're going to find out in depth a little more about all of that in about a week or so with our alumni services team. And then you can connect directly with him when you want to start pursuing some of these things to get kind of like how the SBA acts as like a guarantor of certain loans. We act as if you're a graduate of a program and you go through us to connect to these types of things. You're guaranteed to get something. It just depends on the amount and the interest rate. Some of them are zero interest, some of them are very low interest, and some of them are based on credit score. So just to put that out there as an exciting thing that we can offer. We also have access to 5 different CDFI institutions that we work directly through as well and can help you navigate that space, just so that you're aware of that. Jill, oh, I'm sorry. Oh, how do you advertise for crowdfunding? And Sandra, you want to unmute and share a little bit of what you just shared there in the chat?
Okay, yeah, you can hear me. So it's kind of a catch-22 with the crowdfunding. The positive of doing that is the marketing. It increases your awareness on social media, so it drives traffic back to your website. But the negative is that you have to spend a lot of money on advertising, the Facebook ads. It's not a lot at first, but if you keep going, then it starts to add up. And that's why a lot of them will just break even, but still it's the students that I've seen do it, they have really advanced their businesses. So it can be a good thing, but just be prepared to set that money aside.
Thank you, Sandra. Tim, you asked about pitch competitions. I did mention that it is a little bit different than pitching in front of an investor, but a lot of times in a pitch competition, the judges look for a lot of the same things that they would as an investor, right? Except they're not looking for a return on that investment, and it's not money that you have to give back. It's money that you just get to keep. You just have to show how you're using it. So IBMF sometimes runs pitch competitions. We run those a few and far between. Lakita was part of one in December, just specifically for women. And so that was pretty awesome. Or I'm sorry, it wasn't specifically for women. It was run at a conference that's traditionally for women, but because we partnered with the Association of the United States Army, we opened it up to men as well. So we did have both men and women competing in the pitch competition for a small amount. But still, if you win $7,000, I mean, you can do bootstrapping, right? You can make that money last a while, especially if you're starting up. That could really help. I mean, even a couple of thousand. So a lot of companies out there, Street Shares is one of those that does a lot of those competitions where you might do a video pitch for your business, or you fill out or submit a business plan. And then based on your pitch and your business plan, or based on your presentation, I should say, in your business plan, you might be a finalist, and then it gets sent out to the masses to vote. But they also do loans, and they do loans up to $500,000. I can't tell you exactly all of the requirements there, or what the eligibility is, or what the payback is, but you can find out more about that that'll be shared in the Alumni Services webinar. But you could actually Google Street Shares and find a lot just online as well. But always work through us if you can, because there might be more perks for stuff like that. So anyways, just to talk just slightly more about a pitch competition, you can Google pitch competitions and search, but really what it is usually an elevator pitch or slightly longer. An elevator pitch is really, it's kind of, some people love elevator pitches, some people don't, but really what an elevator pitch is like about a 90-second ride on an elevator or less. I personally have only been on like 2 elevators where I've had to be on for a minute and a half, right? Usually it's pretty quick, but it's really about, if you can pitch your business or idea in 90 seconds, it's basically giving someone enough information to want to know more. And that's really what it's doing, to get them on the hook to what you're doing and to buy them in, to say, that sounds interesting. And it sounds like it could be profitable. Let me hear more. And opens the door to that. And so that's really kind of what a pitch competition is. And then usually a pitch competition comes with supporting documentation, like an executive summary, or a business plan. If you get into more depth, usually the work involved is equal to the amount of money you could win. So for something like a $5,000, it's probably a 90-second pitch and an executive summary and maybe one other thing. But we've done competitions for $50,000 and $100,000. And those are like hardcore business plans that you have to put together and a lot of work involved, but it's worth the reward if you get it. And a lot of companies just want to know how you're going to spend the money, and they want reports afterwards, 6 months, a year. What have you done with the money? And how successful have you been? Because they want to see that story. So I took up a little time there to explain that. But what we do is, when you become alumni, when you graduate from this, you'll be added to our newsletter. And please we only get them once a month, sometimes twice if we have news you can use. And we'll send a mid-month newsletter, literally called News You Can Use. And it's just if we have extra things that have come out before the end of the month and we want you to know about them. But make sure you don't unsubscribe from those, because you'll be the first to know when we find out about pitch competitions. Also, our social media page, when we find out about things like that and opportunities like that, If you like our page, we'll post it. We usually post those things right there. For instance, with Street Shares is running those type of competitions all the time. And 9 times out of 10, when they're running a competition, we have at least one person, if not half of the finalists are graduates of our programs. So which means that number one, they're at a point in their business or idea that it's strong enough to be made as a finalist because of training they've received with us, or 2, they heard about it through us, right? So stay connected with us in that way. Anybody else have some questions? I want to hear from you. How are you funding your business? What are your plans to fund your business? Tim, I'm going to pick on you for a second because I know you're talking about the canoe rentals, right? And what right now is your plan to fund that business? How are you funding it? Do you have your canoes already? What's going on there?
I have the location, the facilities, and we've already started purchasing canoes. The only thing holding me back is working with the city, just all the players that are involved where this river goes through to make sure that there's no showstoppers there. Actually met with a neighbor in the area today and found out there was a canoe rental many years ago, and didn't know that. So it was interesting to find out that there had been one and it did exist. I don't know much about it right now, but financing it is, yeah, like I said, the pitch competition was interesting. So any money that I could get, even if it's a small amount, would be great for me because I'm online right now looking at prices of kayaks and things like that. And there's some amazing prices right now for those type of products. So that's what I'm looking at.
So have you, so far, have you just used your own personal money to buy those canoes?
Yeah, I'm going to try, at least initially, to use my own money as much as I can to get it started. But anything that I could get would help. But rather than going through a bank, because I don't want to sacrifice my house for a business right now. So I would rather, between me and Joni, we're in this together and both have 2 different plans at the same time. Hers is the hospitality with the cabin rentals, and I have the canoes. So I would rent my canoes to her cabin rental folks, and we're trying to bootstrap that way. We're still looking at the bootstrapping idea and how we can combine the 2, and we've come up with a lot of good ideas from this program. So we'll see if we can make it work.
Tim, have you, and I don't know much about the canoe business, unfortunately, but have you looked into seeing if the canoe, makers, distributors, if they have any financing program, if you're buying in bulk or something like that?
Good question. That was something I'm looking at because we do have local businesses that sell kayaks. Like, for example, Rural King is a local business in this particular area in central Illinois. I would have to set up, like a business account with them. And I had that in the back of my mind that if once the business rolls out and all of a sudden I get an overwhelming amount of offers for kayakers, I could go straight to them because they have them on their property. And it's only like 10 minutes from my house. If I needed to, I could run out and buy a few more and put them in the water. But yeah, that's something I haven't pursued. Those are in my, I've collected these ideas and how I'm going to approach the situation once the business kicks off. And I don't know. Now that today, I found out that there had been a kayak canoe rental many years ago. And found out from a friend that his friend bought the property where the actual sign was located downriver and just cut it down with a chainsaw just recently because he said the actual sign was so faded you could hardly read it. So it has been a while since that was there. So it's very interesting to find out. I didn't know that.
Is
But
that's yeah. I mean, good luck in that arena as well. And I think you're right. I think I know you had mentioned the issues you were having with the city, last class, and I hope that in the next couple of weeks you can make headway there. The John especially with the suggestion that John had about connecting with them to see about upkeep, right, and allowing you to utilize that if you upkeep that area for them would be an awesome idea as well. Has anyone else started funding for their business, a loan, peer-to-peer lending, have recently gained some capital in some way? Or do you have a plan? What's your plan? Let's hear from somebody else. Come on. Or maybe you don't have a plan and you don't know what your best option would be. Now's the time. Ask Eva.
Mm-hmm. And is everyone brand new startup? Just making sure. Yeah. Okay. Got it.
The majority of the class is. There are a couple, whether they're on this or watching a recording, there are a couple who were in business previously and are either starting a new business or did a franchise before and are kind of doing something different now. Or I know Shantae, she worked for a larger company, but kind of was a business owner, but didn't get to make all of the decisions. And so she wants to now start her own so she can make all of the decisions and have her own vision.
Okay.
So,
yes. I'm sorry. I mentioned that only because there's usually in these classes we get questions about grants, which are typically my normal answer is no. There's usually no grants, but with COVID and everything that's happened, there's been so many grant programs that frankly, even what I've seen in this last kind of round where they're looking for people to give it to, but usually they're reserved for people that have, or businesses that have already been impacted by COVID. Now, that's not to say that won't change, because in the industry, what we're hearing, and as we're talking about developing new programs, you all have heard the dismal statistics about how many small businesses, unfortunately, wouldn't make it through this pandemic, and that there will be a renewed focus on ensuring that they've got enough new business startups to make up for a lot of the businesses that went out of business. And so now the focus is turning to that. And so I would say just, she mentioned be plugged into the newsletters and things like that, because there may very well be some additional opportunities in the future to really jog new business growth.
Absolutely. And I'd like to mention with grants, Eva, I'm glad you brought that up because, Eva did mention it a little bit earlier that, grants, it's hard to forecast with grants, right? And our institute, one of our main sources of funding, one of our main sources of funding for some of our entrepreneurship programs are grants. And then the majority of the rest of the funding is from private or corporate donorship in the form of a project that we still have to report on. So it is philanthropy. And we still have to report back metrics to so just because, grants have certain requirements, a lot of times corporate donorship. So for those of you that might decide to go nonprofit arena, a lot of big time corporate agencies and even smaller corporate agencies have written into their strategies to give money away to organizations depending on what your mission is and who you are. Being veteran owned or military spouse owned sometimes means that you're part of their strategy as well. Minority owned and a lot of that. So just be thinking about that as well. But those all do come with requirements. There's a reason why grant writing, why people pay a lot of money to hire a grant writer. And it's because you really have to know the space, especially if it's a government grant. You have to know the space. You have to know how to register your business in a certain way. You have to have all the proper documents. You've just got to know how to write the grant so it will catch attention. But we do have some graduates who have started a business as a grant writer. So if that's something you're really looking to do and you don't quite know how to do it, and have the money to hire somebody, reach out to me and I can connect you with some specific grads who their business is grant writing. And that might be the best way to go as you start up. I learned grant writing by diving into this position because as the program manager, I have to write grants and I have to write for our renewals of grants because that's how I get paid. So the urgency is there. And I have to report on grants in specific ways. And keep track of multiple grants. And so it can be a very arduous task. It can be very laborious, but it can also be very rewarding, especially if you get grants that have option years. And so that's what I would suggest. If you ever are really looking for grants and you want the grant to try to create some sustainability, you don't sometimes make sure you're writing in operations to your grant, operational funding, and not just for a specific program or for a specific training. Make sure you're covering operational. That includes salaries, your salary, your employees, or paying for an accountant or a bail team or whatever. And look for ones that have with the option to renew, because renewing a grant is much easier than recompeting for another one, because renewing a grant means nothing's really new and surprising to the person providing the grant, I should say to the government, because they know what you're doing. You just have to resubmit updated paperwork and an updated budget. And that's usually what they require, unless you're adding something to your business or to your initiative or whatever you're putting together, then you'd provide a little more. So sorry, I just went on and on about grants, but I'm not a grant expert. That's just all of what I've learned by doing it. And then as you can see, if by doing it, you will become an expert. So it just depends on, if you want to go that route or not. But if you're ready to go that route, then just be ready to take the leap and really work hard at navigating the space and using IVMF as a resource for that if need be. Eva, do you want to say anything more about grants, or did I say
No,
anything?
I think that, yeah, I give out a lot of grants in my day job here at Fifth Third, and I did a lot of grants at my role at U.S. Bank and Community Affairs. So no, you're spot on. Mm-hmm.
Great. We've got time for one more question if anybody has it. Anybody? Henry, go ahead. You're still muted.
Again.
There we go. Now we can hear you.
Hello, Eva. Thank you very much for doing this for us. And my question is, I've been doing this woodworking business for about 3 years now. So there's some cycles in the business, and there's some high demand time periods. And the things that I'm foreseeing is employees. So, because one of the things that I was looking at is I can't hire a full-time employee and keep him on payroll, maybe like a 1099 employee, like a on demand. Is there something like that can be sourced, as far as finding capital to pay for that, employee in a short period of time? Have you had something like that?
Yeah, that's a really good question. So, seasonal businesses go through this all the time, and usually folks get lines of credit from banks, because that's exactly what it is, what a line of credit versus a loan affords you. So lines of credit are just like credit cards. They're open-ended facilities that are established. Typically, when a bank underwrites your line of credit, they're looking at your cash flow through the cycles, and they'll base your credit availability based on your historical cycle. So when I managed a book of business and I had seasonal businesses within my portfolio, their line balance or their availability would increase during their peak times when they would actually need the money more. And then there would be a cool down as business slowed down. And that when we increased the limit during their kind of busy time, that allowed them to bring on temporary employees, buy more material, whatever it is they needed to do. And that allowed for that. And then once the slowdown came, then there was a resting period, which made you have to pay it down with what should be the cycle if you're receiving now the money from your high period. So that's usually how it works. So I would suggest, talking to your lender who's been in business for years and really, articulating what does that cycle look like. And then they should be able to, create, not create a product, but offer a product that matches that, because that's a very common business. I think the example most folks use is like snowplow business, right? Snowplow business, their lines, they borrow a whole lot in the winter, which is kind of counterintuitive because that's when they should be making their money. But even though they're getting their business in the winter, they're usually not collecting it in full until in the spring. So borrowing goes up in the winter and then it gets paid down in the spring and summer. And so they have products for that.
Okay. Well, appreciate the info. Yep, that's kind of one of the things that putting those ideas and put things in place for the cycles that I experience. Thank you.
Yep, thank you. Mm-hmm.
Great. Anything else? Otherwise, I think we will close our time. Awesome. Eva, do you have any final thoughts for us? Something that maybe we didn't ask that you didn't get to share yet? I know we asked a ton, so.
No, I think you guys, we covered a whole lot, I think in a short amount of time. But the one thing I'll leave you with, you're in great hands with the Institute. And they've got tentacles into a lot of resources. And I think one of the biggest missteps is folks think they have to go at it alone and they have burning questions. And there's a whole world of resources, that are underutilized for small business owners. So make sure that you stay connected, stay tapped in, and don't turn away anything. Get as much knowledge, help that you can on this journey. Absolutely.
Thank you so much for sharing that, Eva. And just a reminder to all of you, again, we are here we are a lifelong network. So I say we have a lifetime support for the life of your business. So as long as you are pursuing entrepreneurship or currently in business, we are here to support you. Like I said, if we don't have a specific resource for you, we have a network and can recommend another resource from another organization. And we have no problem doing that because just as we learned, that's good business, right? Making sure that we can meet your need, even if it might not be from us. Sick. I can never be sick of you, Lakita. Thank you for sharing your email, Eva. We'll post that when we post the recording. And then just a reminder to everyone, next week, same day of the week, same time, Wednesday, 6 to 7:15, we're going to hear from a graduate panel. So successful business owners that are veterans or military spouses that have gone through some of the programs here at IVMF. And we're going to talk about mentorship, networking, taking all that we've learned, putting it into practice, talk a little bit about their obstacles that they had early on. So maybe you can learn what not to do. And then we'll dive a little bit into what a bail team is and its importance. So if you don't know what bail team is, you'll learn next week. And you might even be able to hire the accountant that will be on as a panelist. So she got some business from one of our first cohorts. But anyways, I say all that to say thank you so much, Eva, again, for joining us. Our thoughts are with Ken. Sandra, maybe we could post an old video from another cohort so that they can kind of see, some of the things that Ken shared as well. But Eva, I thank you so much for taking the time to be with us yet again for the fourth cohort. And I'm sure I'll see you again soon. So thank you all. Have a great evening, and we will see you all next week.
Bye, everyone.
Bye-bye.
Bye all.